Okay, let's dive right into this explainer. I want you to meet Leo. Leo is just a regular, hardworking guy. But lately, whenever he opens his phone, he sees all his friends bragging about their investment portfolios. They're talking about crypto gains, target date funds, whatever those are. Meanwhile, Leo is staring at his checking account app, and the balance is exactly $100. He feels completely locked out. To him, the investing world is this exclusive VIP club, and he's standing outside in the pouring rain, peering through the glass, just wondering how anyone actually gets past the velvet rope. He looks at that imaginary $100 bill in his mind and thinks, can you really invest with just $100? Leo has this nagging internal doubt that he's permanently trapped behind the massive, high walls of Wall Street. He figures, well, you must need thousands, maybe tens of thousands of dollars, just to get the bouncer to open the door. And honestly, he feels a little embarrassed, almost like he missed some crucial class in high school that everyone else somehow attended. So there he is, $100 in checking, zero idea how to start. But before Leo even tries to buy a stock, life hands him his first real lesson. He's looking at his budget and realizes he's carrying a credit card balance with a whopping 25% interest rate. Then he reads an article that hits him like a ton of bricks. Paying down high-interest debt is a guaranteed return. Think about it. The stock market averages around 7 to 10% a year, but his credit card is charging him 25% right now. So he realizes his first actual investment is wiping out that high-interest debt. Once that's cleared, his $100 is finally ready for Wall Street. Section 1. The $100 Breakthrough. Discovering Fractional Shares. Life basically forces Leo to just try it. He downloads a brokerage app, types in the ticker symbol for a massive, famous tech company he uses every single day, and hits buy. Bam! A big red error message pops up. Insufficient funds. The stock is trading at $500 a share, and Leo only has his 100. He slumps back in his chair, feeling entirely defeated. The wall is too high, the VIP club is closed. But then, a buddy tells him to look a little closer at the app settings, and this leads to his first major breakthrough: fractional shares. Leo realizes that he doesn't have to buy the whole stock. It's exactly like walking into a pizzeria and buying a single $5 slice instead of needing to afford the entire $20 pie. For the first time in modern history, he can buy $5 worth of a $500 stock. The wall just completely crumbled. The industry has completely changed to welcome everyday guys like Leo. He does a little research and explores apps like Acorns that automatically round up his spare change. He looks at SoFi, Cash App, and traditional heavyweights like Fidelity. And what does he find? $0 minimums, $0 commissions. They are practically rolling out the red carpet for his $100. Wall Street isn't a walled garden anymore. The gates are wide open. Section 2. Navigating the maze, finding the right account. Empowered by his apps, Leo sits down to formally set up his account. But almost instantly, he's lost again. He's hit with a confusing alphabet soup of financial jargon: 401k, traditional IRA, taxable brokerage, Roth IRA. It's like reading a foreign language. He just wants to invest his pizza money, but now he has to choose a tax vehicle? He sighs, rubbing his temples. Through some trial, error, and a lot of late-night reading, Leo finally stumbles upon his golden ticket, the Roth IRA. He learns that with a Roth IRA, you put in your $100 after you've already paid taxes on your paycheck. But the magic happens later. When Leo turns 59 and a half, his future self gets to withdraw all that compound growth completely tax-free. He realizes that for a beginner earning a normal salary, this beats almost every other option out there. Section 3. The market dip, Leo panics. So, Leo is in. He's got his Roth IRA, he's buying his fractional shares, and he's feeling like a king. Fast forward a few months. Leo wakes up, checks his phone, and his app is bleeding bright red. The stock market has taken a sudden dive. His hard-earned money is shrinking right before his eyes. His heart races. He's hovering his thumb over the sell all button, pushed to the absolute brink of panic. He's thinking he made a huge mistake. But before hitting sell, Leo takes a deep breath. He steps away from the app, does a quick search, and unlocks what becomes his absolute secret weapon: dollar cost averaging. He learns that trying to time the market is a fool's errand. Instead, by investing a fixed amount of money on a regular schedule, no matter what the market is doing, he actually removes all that messy emotion from the equation entirely. Leo realizes that his automated $25 a week is basically a superpower. When the market is up, he buys fewer shares. But right now, when the market is down and his app is red, that same $25 buys more shares at a massive discount. He's literally getting his favorite stocks on sale. What was a moment of sheer terror suddenly transforms into a mechanical wealth-building advantage. He slowly takes his thumb off the sell button. Section 4. The Hidden Villain. Attack of the Fees. Just as Leo feels like he's finally playing the game like a pro, he uncovers a hidden trap. He's looking at a really fancy, actively managed mutual fund that sounds super impressive. But then he spots a tiny little number buried deep in the fine print, a 2% expense ratio. Now, 2% doesn't sound like much, right? It sounds like pocket change. But Leo decides to do the long-term math. Leo's jaw physically drops. He finds some data from Morningstar that shows the horrifying reality of that tiny fee. Over a 30-year investing timeline, a 2% fee compared to a low-cost fund could devour $460,000 of a long-term portfolio. That isn't pocket change. That's a house. That's his entire retirement. The hidden villain was quietly eating his lunch money every single day.
Seeing this devastating visual difference between a low-cost index fund and a high-fee active fund changes absolutely everything for Leo. He immediately switches his strategy. He abandons the fancy, expensive funds and moves his money into total market index funds that charge practically nothing, sometimes even 0%. He is now fiercely protecting his future wealth from Wall Street's hidden toll booths.
Section 5. Setting autopilot, the boring path to wealth. By this point in his journey, Leo finally gets it. He realizes the biggest secret of all. Investing isn't about being a Wall Street genius in a tailored suit. It's not about watching multi-monitor setups and yelling buy or sell. It's actually about being remarkably, consistently, incredibly boring. It's about setting things on autopilot and walking away to live your actual life. So Leo sets up a clean, beginner-friendly system called the 3-fund portfolio. It's elegant in its simplicity. He puts about 70% of his money into the total U.S. stock market, 25% into international stocks to capture global growth, and a safe 5% into bonds. No picking individual hot stocks, no crypto gambling, just owning a tiny slice of virtually every profitable company on Earth. It's completely accessible, and it takes him maybe 5 minutes a year to manage. Leo smiles as he runs his final calculation. If he simply automates investing just $100 a month, about $25 a week, into this boring, low-cost portfolio and leaves it alone for 40 years, assuming historical market returns, it could organically grow to over $250,000 in today's money, all from an amount he used to accidentally spend on takeout and coffee. Let's connect the dots of Leo's entire journey, because this is the exact, simple blueprint that transformed him from an anxious, embarrassed beginner to a confident, automated investor. 1. Start with the $100 you have. 2. Open a tax-advantaged Roth IRA. 3. Buy fractional, low-cost index funds. 4. Automate your monthly deposit so you never even have to think about it. And 5. Never, ever panic sell when the app turns red. A few months later, the market inevitably dips again. But this time, Leo doesn't panic. He actually smiles. He remembers a quote he read from Warren Buffett. When we bought anything, we always hoped it would go down for a while so we could buy more. Leo embraces the dip with open arms. He knows his automated $25 is swooping in, buying the discount, and quietly, steadily building his financial empire in the background. Leo figured it out, not by being an expert, but by just starting. He took that single intimidating step, and the path revealed itself. Now the wall is gone. The doors are wide open, and the tools are literally right there in your pocket. Your $100 is waiting right now, just like Leo's was. The only question left is, what will your first slice of the market be?